if there was any problems that somebody had, I'm going to be willing to give it to them. But going forward, I'm probably not going to. I'm going to be a little less likely to do that. I don't think it's really fair that all of us have to, a good majority of us have to get up, and some other people don't want to. But if you have a good reason why you need them recorded and sent to you, I'm happy to do it. In fact, that's why we were required to meet at the designated time of the class, was because it was one time that we were all guaranteed everyone had available, because this is when you would have been normally in class anyways. Second thing I wanted to talk about, the discussion board posts. That's something that I kind of came up with. Just a little bit of history about me, if you guys don't know. I used to teach at University of Maryland, University College. It's a primarily online university. I mean, not, well, yeah, I would say the majority of the classes are either taught online or what they call hybrid. So what ends up happening is you go to class 3 hours a week, and then you have a massive amount of work to do outside of class through the online environment. That would be a hybrid class. The benefit of that is that instead of 16 weeks long, they're only 8 weeks long. I have a lot of experience with that, and so one of the ways that we would actually do stuff is that we would have discussion posts. My initial desire was to replace the quizzes with those discussion posts. I think you guys would enjoy those a little bit more than saying, surprise, there's a quiz today. However, I received an email from somebody that might suggest to me that I'm not allowed to do that. So I have to get clarification on that. For this week, I will promise you quiz amnesty in exchange that you do the one question that I post. If I have to change it, I will not change it until next week. I don't think it's fair to kind of mess you guys around a lot like that. So that's just kind of what I want to make sure that we do. Okay, so this is going to feel a little weird, I suppose. I'm used to kind of talking in the camera. As you guys know, I do a lot of YouTube, and so this probably isn't as difficult for me as anyone else. I'm really sorry if you're listening to this simply on the phone. I would hate for, I think the screen's going to help things a lot more. And, what I've done is I've prepared an Excel or two so that I could demonstrate if I, if I need to do something else in order to be able to show you guys. So sorry for all that flickering. I was trying to get the Excel activated. I forgot to activate it before I started class today. All right, so today, oh yeah, not last of all, I didn't get a chance to finish the schedule last night like I wanted to. I'm waiting to get that done. Hopefully by the end of today. Basically, we're going to pick up where we left off. The only major changes that we're going to have is that there won't be a review day. And part of the reason for no review day is because if the test is going to be open book, I don't know if there's really much to review. You're going to have, most of the questions that you're going to have are going to come right out of the book, from the book material. I mean, they're, or from the PowerPoint material. I don't try to have a whole lot of surprises, unless it's like, bonus questions or things of that nature. I'll be honest, I haven't decided if there's going to be any bonus questions on the test, though, however, simply because bonus questions, in my opinion, should be something that you get because you were extraordinary in paying attention in class. Next thing I know, there's going to be chat rooms where everyone's sharing answers on the bonus question. I don't know. I'm still kind of new to that part of it. This is the first time I've had to do sort of a take-home exam in an accounting environment, in an online environment. So we'll see how that goes. Any questions for me for anything I've said before I begin? Okay, if you have any questions and you want to ask me during the class, if it's something that I said that's absolutely wrong, feel free to go ahead and stop me if you need to really ask some stuff. But if it's something that you want to ask, more one-on-one-ish, go ahead and use the chat rooms. And then also do me a favor, make sure that when you're sending them, send to everybody. That way, if you do have a question, but if you have a question that you directly want to ask me that you're afraid to ask for anyone else, you can send it to me directly. And then just make sure that you mention in your chat that you're sending it to me directly, because I don't think this shows me. I've never, first of all, I've never had anybody ask me a private question in one of these meetings before. Usually these are very open discussion when we use GoToMeeting. But you know, just make sure that you tell me, hey, you know, on private chat, blah blah blah. Can you do that? Question: will I have an outline of the exam that we're able to better prepare for the exam? Again, I'm not sure what preparation you really need to do other than reading the notes, and you know, and I'm sorry that I don't have that, but I don't have an outline of the exam because I mean, what's going to happen is I'm going to give it to you. You're going to have more than a week to do it. I mean, do you guys really need an outline of the exam? You know, for an exam that you're going to have an entire week to prepare for? All right. Okay, because I'd rather spend that extra day doing something else that everyone can probably enjoy a little bit more. You know, I mean, again, if you feel like you need one, just reach out to me, and you know, I know some people may be a little concerned about saying things on the public chat, but and yeah, if you have any questions about it, you can reach out to me. I don't have any issues. Um, Second, I mean, before we begin the class, though, I do want to kind of talk a little bit about what's going on in the exam, I mean, in the industry as a whole. You know, one of the things, obviously, all of you guys are interested in becoming accountants. I hope that I can convince you to go into public accounting, tax accounting. It's a very wonderful my career field. Um, the main things that have been happening lately, of course, as you know, because of the coronavirus, you know, and the whole social distancing, probably the biggest change that I've seen from a lot of people is the reduction of in-person meetings. Um, I would say that CPA work, particularly when you're working with high-level individuals, they want to talk to you. They want to see you. They want to interact with you. And as the owners of the firm, we want to interact with our clients, because if we get good interaction from them, it's harder to fire somebody that you really like. You know, I think is probably the best way to do it. Social distancing, unfortunately, kind of prevents a lot of that from happening. So I think that you know, when we're kind of looking at it, that's probably been the biggest impact of the whole industry. Our firm is less than 10 people. I've made it optional whether they could come to work or not. I know a lot of firms are doing mandatory teleworking. I know some other firms that I have. It's basically if you're able to telework, they'll let you telework. If you're not able to telework, they're either telling you can stay home on paid leave, or you can stay home and you know, take sick pay or whatever. Depends on the firm also. One firm that I know that does comp time, there's a lot of people who were building up comp time before the shutdown of the firm happened, and so they were able to use some of that comp time that they built up. Now, comp time, for those of you who don't know what comp time is that, you know, in a salary environment, I don't have to pay you for overtime, but I can make you work overtime. And basically you get a flat salary. And so there's certain requirements in order for me to be able to do that. That's more of an HR type thing than an accounting type thing. But if you're classified as an exempt employee, that means you're exempt from the overtime rules. And so what happens is if you're exempt, I can work you 70 hours a week, and you really have nothing to say other than, you know, if you don't like it, you can work somewhere else. For the most part, most firms, you know, that are small firms, all they're going to do is they're just going to bring you on as a salary, and they're going to work you as long as they can, and you know, they're going to expect you to get your work done. Now, some firms will do it hourly. I know one firm, I think Thomson Greenspan, used to do hourly salaries, which sounds great because during tax season you're getting overtime. The disadvantage of that, however, is that during the summers, they shut down on Fridays, and you're working only 4 days a week and 32 hours a week. So, you know, it's almost like, you know, save up all your money that you make during tax season, because you're going to need it when you drop 8 hours a week. Um, another firm that I worked at did this thing called comp time, which is basically for every hour that you work more than 40, you can bank that, and then you can use it as a vacation time later on. And so I tend to think that's a better deal, because if it's a good deal to if you're on the thing and your microphone's activated, please go ahead and hit mute, because we can hear some background noise. Thank you. I tend to like comp time. The reason why I like comp time is because it allows me to use the vacation days as I see fit. I remember when I worked at the firm that offered comp time, I remember taking a 2-week vacation that I only used a total of 4 vacation hours for. It was wonderful. You know, you don't get to do that very often if you're working in any other situation. So, so those guys are actually benefiting from that comp time pay structure because they're able to stay home during the time that they've got and kind of work things out. So, so anyways, we'll go ahead and we'll start class. Today we're going to talk about Chapter 14, Consequences of Home Ownership. Consequences of home ownership. So as we've talked about in the past, you know, just to kind of do a little bit of a review, I know it's been almost 2 weeks since we last talked, but basically what happened is that when we did our last conversations, we talked about if you buy real estate, you know, you're gonna pay a cost for that, and then that's going to be your basis in the property. If you turn that into a rental real estate, or if you turn that into if you turn it into a use for a business, you're going to depreciate it, which is going to, you know, be a reduction in your basis. If you do any improvements in your home, you're going to actually increase your basis. And so those are some of the ways that your basis gets adjusted, which is why we call it adjusted basis. When you sell your property, the amount of the price of the contract is going to be the amount realized, and then below that, your amount realized is going to be modified by your selling costs. You know, very good example. I just did an analysis for somebody this morning, and basically what they had done was they sold their house. They did a whole lot of improvements. And they were asking if they could go ahead and get an analysis done. And so when we did the whole thing, one thing I did do is that I estimated the selling costs of this, and it ended up reducing their gains by somewhere in the neighborhood of about $40,000, which is a lot of money. In this case, they were trying to do it for the state that has a flat state tax of 6%. So they were trying to reduce their withholdings, but that's something that we do, you know, more typically in the off season. But this client wants to do their sell of their house in the current year, so it is what it is. So what I will end up doing here, you know, is just kind of going over the slides, telling you where I think that we need to do a lot of focus on, and then also kind of telling you where the stuff is. So the first thing we're going to do is, you know, these are our learning objectives we're not going to talk about. So first thing we're going to do is we'll talk about what a dwelling unit includes. Homes, condominiums, mobile homes, boats. A very common misconception about people with their boats is it can be considered your primary residence. I've known 2 people in my life who this was their case for many years. What happened is that I had one. Actually, he wasn't a client. He was actually a reporting director of mine. He was a captain in the Navy, which is an 06. He never rented a house anywhere he went. He bought a boat, and anytime that he moved from one base to the next, he would captain his boat to wherever he moved it to. You know, it kind of made it a little difficult if he went from one coast to the next, because he would have to sail around to Panama and come back up. But he'd do it, and it was you know, he'd take the requisite amount of time off in order to be able to do it, and it wasn't a big deal. You know, there are certain requirements in order to be able to write off your house boat, so to speak. You know, the interest and all the taxes that you pay on it. Basically, I mean, there's certain things like it has to have a toilet, it has to have kitchen facilities. I can't remember what the rest of it is, but that, I thought that was kind of neat. I mean, the guy, he owned a boat that probably cost him around $150,000-$200,000, which was cheaper than a lot of the houses here in the Washington D.C. area. All he had to do was pull up and dock, and pay dock fees, which were nothing compared to what he would have to pay for if he bought a house in D.C. So it was a great deal for him. There can also be other similar properties. I don't know what other kind of properties there would be that I've ever seen personally, but I'm sure that there's probably something somewhere in different cultures that have it. Let's see, dwelling units can also be used, of course, for personal use, and then also mixed for personal and rental use. We're going to talk a little bit more about this here later on when we talk about, oh yeah, actually, let's go ahead and we'll do that now. So the big thing that they talk about here, there's certain gates that we have to adhere to when we are when we're dealing with whether residence is going to be a residence for tax purposes or a non-residence for tax purposes. For the dwelling is a residence if personal use days are more than the greater of 14 days or 10%. And otherwise, it is a non-residence for tax purposes. Okay, so what this actually creates, and I've actually created sort of a little bit of a chart here for you guys to see. Usually, when I deal with this and I talk to clients about it and try to explain to them various parts of this, I go ahead and I here actually I'm gonna see if I can expand this because I didn't realize how small that would be on the screen. Whoa! We'll make that 20. Wait, it's readable. All right, so and you might be able to see the lines that are over here and that are over here, and these lines represent 14 days. Okay, so if I have 14 days or less of personal use, this is going to be a rental property. Okay, for all intents and purposes. If I use it for 14 days or less as a rental property, I'm sorry, if I have 14 days or less of, let me back up. Okay, I think I just screwed myself up. If my rental days are less than 14 or less, it's 100% personal use. If the personal days are 14 days or less, it's going to be rental property. Okay. This gray area that we have right here is the vacation property. And we'll talk about what the tax differences between these ones are. But for the most part, the main thing that ends up happening is if it's considered rental property, it's basically like a business. It's just that instead of it being a business where you are, instead of it being a business where, you get to write off everything, it's going to be a passive business. Instead of being on Schedule C, it's going to be on Schedule E. E is an echo. And the thing is that anything that is ordinary and necessary to a rental property is going to be deductible against the income that the property generates. So, for example, if you make $30,000 in rent income on this property, but you end up spending $35,000 on the house, you're going to have a $5,000 loss. And those things that are included in that are HOA fees, mortgage interest, taxes. I'm trying to think of some others. Oh, insurance, management fees. And those are perfectly deductible legal expenses. Okay, so now you might be asking, well, what's this thing called the vacation property? So the vacation property is sort of the quasi area. It's where you have certain aspects that are personal use and certain aspects that are rental use. We'll talk about those in more detail when we get to that section. But that's kind of what they're talking about here when they say 14 days. Now, they do say 10% of the rental days during the year. So if you have, so say, for example, you decide that you're only going to rent it out for, 90 days. And a very common thing with this is if you are, I'm trying to think how I want to say it. So, for example, if you go up to Deep Creek, Maryland, it's like a big, huge area for vacation homes. It's actually a very, ritzy kind of place, where a lot of people go and they vacation up there. You may only rent your house out for 90 days during the year because during 90 days during the year, that's when the season is for renting. Well, if you rent it out only for 90 days during the year and the rest of it, it's dormant, what ends up happening is that you would bust the vacation, I mean, you would bust the rental property rule if you used it for more than 9 days. Okay, so that's where the 10% comes in. Practically speaking, guys, this almost never comes up. I mean, it's almost I think I've worked on one return in 20 years where I've had to really be concerned with 10% of the number of days versus otherwise. Because what happens is that most of the time when people buy these houses, they never stop trying to rent them out. They just keep renting them out anyways. And so what we do is we always tell clients in that case, go ahead and you can use it for your 14 days, and then just make sure that you keep it on the market for as long as you can. Now, traditionally, the summer renting season is actually usually longer than 140 days anyways. So that's why this almost never comes up. So personal use includes days the owner stays home, stays of a relative who stays in the home. And when they say relative, they're pretty expansive on this. I mean, it can even include cousins. That includes even if they pay fair market value of rent. So you want to make sure that if you just, so for example, if you have a client who has a vacation home, say in Deep Creek, and they say, hey, look, I've got this vacation home, cousin, why don't you go ahead and head up there for a week? Don't worry about it, we'll take care of it. That actually counts as personal use days for the owner. Days an owner stays in the home under the vacation home exchange or swap, almost never run into that. Days a taxpayer rents out the property for less than fair market value. That is actually something that has come up several times. Usually when people rent it out for less than fair market value, they're only going to do it for family. Or they're going to do it for a very close family friend. The thing is that what's fair market value? Fair market value is whatever a willing person's willing to pay. So if you do not, if you have somebody who's trying, you're trying to rent it out and nobody's willing to pay for it because it's not able to be used, and so you find somebody who's able to rent it, but they're going to rent it for maybe $1,000 less than you would during the high season, well, that may be fair market value. So this gets a little wonky, and it also depends on what fair market value is defined as. And so you want to make sure that you're taking that consideration when you talk to your clients about that. Rental days include days when it's rented at fair market value or days spent repairing or maintaining home for rental use. Practically speaking, this isn't really something we talk too much to our clients about. Usually what happens is we say, okay, when did you start renting this out? And they're going to say, well, we got our first rent check on May 1st. And that's not the question I asked. The question that I'm asking is, when did you first set this up so that it was going to be a rental? And usually what happens is it takes about 2 to 3 months in order to get a rental established. So what will happen is they may get their first rent check in May, but they actually decided that they're going to turn this into a rental as early as January of that year. So we would go ahead and we would start the rental period as of January of that year, because any of the time that it spends on the market in order to be rented is considered a rental property. And then all those expenses in order to get that done will also be deductible. Another thing that they'll say that is going to be very commonly deductible is any cost that is spent getting the home ready to become a rental. So for example, I move out of the house, it was my personal house, and I move into another house. In order to get that house ready, I go ahead and I set up a painter to come in. So the painter will come in and do all the painting. That is a deductible expense for the rental property. So now how it's deducted is, the question is, would we consider that an improvement or would we consider that an expense? Okay, so if you have a rental property, and actually, in the way that I would actually look at it, and I think if I looked at, I don't have my depreciation guide with me, do I? Yeah, I didn't bring it back here. I believe it's actually considered an improvement under the depreciation guides, and I think it's considered 1250 improvement. And the reason why it's considered a 1250 improvement, when we say a 1250 improvement, what do I mean? 1250 improvement means that it's going to be capitalized and it's going to be considered an asset under Code Section 1250, which when we talked about in the disposition of property is subject to recapture at 25% or up to 25%. Okay, so let's see. So the next thing is that it says, is a residential a principal residence? Oh, I thought somebody was going to jump on and ask a quick question. So the next thing that they'll say is, let's see, days that a home is available for rent but are rented out are not personal or rent days. That's not exactly correct. I would say they're rental days, and that's how we've always treated it in the past. That would just be my personal opinion. But that I would actually fight that. I don't think I've seen the rules that says that if it's available for rent but not rented out. I disagree with that. I don't think that's correct. If you're actively engaged in the activity of trying to rent out your home, i.e., and this is what we do. What I do is I tell my clients, hey, get on to the to the rental places, put out an advertisement. If you want this thing to be deductible, spend a little bit of money to try to get some rentals in there. Not spend a whole lot, but you have to just do, put an ad out there. We've had an ad out there for 6 months. Okay, so I had a question. This is what the textbook says. If it's on the test, what should we go by? I would go by. Yeah, I would say go by. Well, first of all, I don't think I would put this on the test. What I would do is, the way this is going to show up on the test, if we actually do this on the test, is I would say, hey, look, so and so used it personally for 9 days. However, they confess to you that they only put it out for rent for 80 days. So there's 80 days of rental, and then there's 9 days of personal use. Did they bust the rule? Well, under the 10% rule, they would have busted it. Okay, so that's kind of how that would end up. All right. Carlos, thanks for the question. Actually, very good question. Let me actually, there's one private one that I want to see if I want to ask. Let's see. Yeah, actually, I'm going to put this out on public. I'm not going to say who asked the question, but I'm going to at least ask it. They said if one of your property is rental property and then you decide not to rent it, can you do that? And the answer is yes. I actually had a client. I have one of my clients who actually he drives me nuts. I can't tell you how much he drives me nuts on this. What he does is that he'll put a property out for rent, and then when it doesn't rent anymore, and he wants to move in there in order to fix it all up and do all that sort of stuff, he physically moves into the property for like 3 to 4 months in order to fix it up, and then he moves out of it so that he can turn it into a rental again. And it drives me nuts because trying to figure out where this guy's living almost every year is like a constant challenge. I've actually recommended to him, go get a UPS box. That way I can just send everything to one address. We don't have any issues. You can do that. I think the biggest problem that we see with this is that some people will, some people when they do this, you need to make sure that you're not taking depreciation during that. If you're on speaker, please go on mute. I see I've got 1, 2, 3, 4, 5 people on speaker, so please make sure that you're not doing that. Okay. Okay. So anyway, so that's kind of what you got to make sure that you're doing. If you are if you're not going to rent your property out for a year, what you need to do is that you need to say, okay, look, I'm going to go ahead and I'm going to take it off the market, and then I'm not going to rent it. I'm going to use it as personal property. Now, here's the problem that you have with that, though. You will have to track the depreciation that you've taken on the property, because if you ever do sell it, the Section 121 exclusion, which we're going to talk about later on, will not get you out of the depreciation recapture. It will only exclude gain that is not subject to depreciation recapture. So you want to make sure that you're taking care of that. Okay, good question. And then they have the other thing that says, is a residence a principal residence? And the answer is, okay, so the amount of time they spend at each residence, proximity of the residence to place of employment. What this is trying to say is that it's all facts and circumstances. And something you're going to learn if you get into tax and you do get really deep about it, the IRS has really, in the broad scope of every type of test that the IRS has, they have 2 types of tests. The first type of test that you have is what's called the mechanical test. The second type of test that you have is what's called the facts and circumstances test. Mechanical test is basically it's binary. It's on off. You either qualify or you don't. Done. A very good example of it is that if you want to qualify for what's called the foreign earned income exclusion, you have to be outside of the United States for 330 days of 365 days. If you're outside of the United States for 331, you qualify. If you're out for 330, you qualify. You're out for 329 and that's it, you disqualify. You are not qualified under that test. It's either an on or an off. You either qualify or you don't. The second type of test is facts and circumstances. As you can tell here, what they're doing is that they're saying, is the residence principal residence? And the amount of time that they spend at the residence, proximity, are they giving you actual hard fact numbers? No, they're not. So they are giving you sort of a facts and circumstances test. Now, in case you're wondering about the test, no, I'm not going to probably give you a whole lot of facts and circumstances type questions. And if I do, they're going to be so broadly easy to figure out that you're not going to have to worry about it, okay? I just wouldn't do that to you. I mean, facts and circumstances, CPAs argue facts and circumstances all the time. And these are guys and gals who've been in this industry for, 20, 30 years. I wouldn't do that to you guys on a test because no offense, you just don't have the experience. So most of the stuff that we're going to do is more mechanical and also more focused on the fact that, we want to, sort of just get you the idea of whether you get it or not. Sorry, my camera disappeared on me again. All right. So for a given year, a dwelling may be a residence, principal residence. Okay, so yeah, so that's true. You can have more than one principal residence under the law. Because there are some people who actually live in two homes. I have one client spends 7 months out of the year in Florida, spends 5 months out of the year here in Virginia. That's what he does. So he has two principal residences. Obviously his primary residence is where his residency is determined is actually going to be located down in Florida. But it's but that's kind of what we're going with on that. Now there are people who buy multiple houses. And they do so with the idea that, okay, we're going to go there, but we're going to just live there for, a few weeks out of the year and that's it, but they don't want to rent it out. So, I have a couple clients right now who are, they're snowbirds, which basically means that they live in, actually these guys live in California, so I guess they're not truly snowbirds, but they live up north and they just bought a house in Myrtle Beach. So, during the summer, they spend 2 months down in Myrtle Beach. And it's all good, but they do not rent their property out. So it's been a very interesting situation for them. It's considered a residence, but not a primary residence. And they pay so much interest on their primary home, it doesn't matter anyways. So non-residence basically means it's rental property. Okay, big question that I just got from somebody: is Airbnb considered a rental property? Airbnb is actually a controversy within taxes, believe it or not. There's a lot of rules, and I'll be honest with you. I have a very good article that Checkpoint put out on this. I'll see if I can dig that up. But what they did is that the biggest question of the day is because think of it from this, and I want you to think globally, kind of for a second. If you rent a house out and you do it for a few days, and so let me back up on this. So basically the rules are: when does your house stop being a rental property? When does it stop being a personal property? And now, because of Airbnb, when does your house actually convert into a hotel? Okay, that's something that we're actually noticing with a lot of Airbnb people, is that if you're renting your house out, say you rent your house out to somebody and they're going to rent it out for 30 days at a pop, you're going to be that's going to be considered a rental property, is basically the way it works. But if you're renting it out to people and they're only staying 1 or 2 days and then they're leaving, and then you rent it out to another people who rent it out for 1 or 2 days and then they leave, and you rent it out to another 2 people who rent it for about 3 or 4 days and then they leave, the IRS is actually considering that a hotel. And as a result of which, that makes it a Schedule C. So when we get Airbnb, we actually have to to do some serious looking at how this gets taken care of. Now, something that we haven't talked about yet with personal property. Let me go back to this because actually this brings me back to a point. I was going to talk about it a little bit later on, but I guess now is actually a good time to bring it up since somebody asked. If I have any rental income over here, it's going to be on Schedule E. If I have any rental income over here as a vacation property, it's also going to be on Schedule E, but it's going to be subject to a lot of limitations. If I have any rental income during the personal use time where my rental income is less than 14 days, it is actually 100% tax-free money. You know, a very common story that I always told people, go buy a house right next to National, buy an apartment right next to National Stadium. Next time they have a World Series, rent your house out for a week. You can rent your house out for a week to a bunch of people who want to go there and party and go to the World Series for the entire week. It would actually be 100% tax-free income. It's one of the areas, it's one of the few areas of the code where they do not tax you. Now, my recommendation would not be to go buy an apartment everywhere next to, okay, so someone was said, so how would an Airbnb recognize itself if it has 1 month that it rents every 2 to 3 days and then 1 month there it rents a weekly? In your facts and circumstances you presented, Andrew, I would actually say that would be a hotel situation if you're doing it constantly. That's how I would look at it. But I'd also have to take a look at how involved are you. If this is something that you're doing, that you're spending a lot of time with, I definitely would say that it's probably an active trading business, which has its advantages and its disadvantages. I mean, there's definitely some things that we would want to examine to see if we wanted to take one position or the next. I think that because it's not really been settled science within the IRS community, I think that there's a lot of wiggle room in terms of stuff of that nature. But if you're saying it rents out 2 to 3 for 1 month and then it rents out weekly during ski season, but then goes back to 2 to 3 days a month, I'm more leaning towards the fact that it's a hotel just because it does that. Now, if it's but also a week really isn't the big trigger. I would say if you rented it out for an entire month, that's where we're going to have a lot more wiggle room to go back to being a rental property instead of it being a hotel. So good question. Oops. So I killed all that. Okay, so try to get back on track here. So this is what they're talking about, the different types of deductions. I'll let you read that on your own. So tax and non-tax considerations. Non-tax, okay, so it's no secret, I'm a big fan of realtors. I used to be a member of the realtor associations nearby. I've actually dropped my membership with them, not just because I haven't had time to go there and it wasn't generating me much anymore anyways. The non-tax consequences of home ownership, and a lot of this actually comes from the National Realtor Association. It is a large investment. It's the largest investment almost any American's going to have. There's a potential for a big return or loss on the investment with use of leverage. So basically what leverage is that I spend $10,000 buying a house that cost me $120,000 because I go ahead and I loan them, I borrow the money, and then I go ahead and I sell it for a $15,000 gain. I've effectively, on my investment of $10,000, I've effectively made 150% profit off of that $10,000 investment. So there's there's an immense amount of potential for that. Now the good news is that even though I made 150% of my income, I'm not being taxed on 150% of my income that I would have. I'm only being taxed on what I buy the house for, which was say bought for $120,000, and then I sold it for $135,000. That $15,000 difference would be capital gains. But if it's my primary house, 121, not paying any taxes on it at all. So it's actually a really good deal. Okay. So risk of default on home loan, there is a risk. That is something that we saw, especially in 2008. We're seeing now with the coronavirus, they've actually gone ahead and they're keeping it. They're trying to tell people that they're going to go ahead and prevent defaults during this time, which the thing is that I will actually not default foreclosures. They'll prevent foreclosures at this time. I don't know. There seems to be a lot of stuff that a lot of home people, a lot of the loan people are actually trying to come out with programs to help people stay in their house. I know most people in the class are renters, so this, you probably don't know a whole lot about this, but for the most part, my biggest concern, of course, during this whole coronavirus thing is that people get behind on their payments, and then when they go back to work, they're going to try to struggle to get back caught up. I think what's going to happen is you're going to see a lot of people taking out personal loans during this time in order to get by. Banks will probably want to do that if they've got good credit, but if they don't have great credit, they're not going to have that ability. So hopefully, Congress does what it's supposed to do and gets the relief to the people so they can get it. But and I don't want to talk about politics, especially since I know today's is being recorded. Tax consequences of a home ownership. The interest expense is deductible. The gain on the sale is excludable. Real property taxes are deductible. Now, of course, the biggest problem that we have with real property tax being deductible is that state and local taxes, or what we call SALT taxes, are only deductible up to $10,000. So if you buy a really nice house in Vienna, Virginia, more likely than not, your taxes are going to wipe out any tax deduction that you're going to get off of the home. So it's actually going to be an interesting endeavor on that. Rental and business use properties. Yes, you can take an office in your house and you can turn it into a rental property. It's not a rental property. You can turn it into, you can take a space in your house and turn it into an office. I used to have a home office when I first started Beta. I didn't write it off because there were certain reasons why I didn't, but it does give you that opportunity. And then you can also, one thing I've told people in the past, the reason why I own my 3 rental properties that I did, they were houses I used to live in. I decided when I moved out, I don't want to sell it. I want to turn it around and rent it. And it turned out to be a good deal for me so far. So that's good. So when you sell a personal residence, gain or loss recognized on a capital. So typically when you sell a capital asset, which your sale of a home would be a capital asset, gain or loss will be recognized as capital gain. However, back in 1997, they went ahead and Congress actually came out with the idea. This is actually, the Realtor Association didn't even ask for this. This was just something they came up with. They said, look, we want to exclude the gain off of the first $250,000 of gain for a person's home. And so, and part of the reason why the IRS decided to do that is before they did this exclusion, you could do a lot of what we would call 1031s on your house. And so what would happen is you'd sell your house. As long as you bought a new house within 6 months, you didn't have to pay any taxes on it. Well, sometimes auditing that stuff would take so much time and so many resources. They wanted to make sure that they didn't have to do that anymore. And so what they did is they said, look, we're going to change the rules in order to reduce that. So that, because if you think about it, if it's your personal house, the way most people look at it, they don't buy a house simply because they want to make money. They buy the house because they want to live in it. Now, if they make money at the same time, hey, bonus, we get it. So that's actually a good deal. So so that's how this kind of works out. They say part or all the gain might be excluded if the taxpayer meets certain requirements. Okay. So the exclusion, the maximum for the exclusion is $500,000 married filing joint, and then it's $250,000 for other taxpayers. Gain in excess of exclusion is going to be taxed as long-term capital gains because obviously if it's more than 1 year, it's going to be a long term, so it'll be taxed that way. You have to meet the ownership and use test in order to qualify. That's 2 tests, ownership and use. Ownership is usually not the problem. The problem that we run into with most clients is the use test. And the reason for that is because with the use test, what happens is you'll have clients who basically what they do is they say, look, I've owned this house for 15 years, but I've only used it for, I used it, for the first 10 years that I owned it, 5 years ago. But in the past 5 years, I haven't set foot in the house. Technically, you bust the use test. And so that's something that you have to ask your clients on. The taxpayer must, we've kind of talked about it. If married spouses, either spouse can satisfy the requirement. This actually is very common, especially in second marriages, where you have So say for example, or I mean, I guess you could also have this in primary marriages where both spouses own a house. They decide to get married, so they move in together, and they say, well, we got to sell one of these houses. So they decide to sell one of the houses. We'll say that they sell the guy's house. So when they sell the guy's house, they put it on the market and they want to sell it. You know, as long as the husband's house, husband had the 2-year rule met, they're going to have it met for both married clients. Okay, for both married, for the taxpayer and the spouse. Okay, so as long as one of them meets it, they're going to allow you to have both of them meet it. So it's not a big deal. So the requirement is meant to prevent taxpayer from buying a home, fixing it up, and soon thereafter selling it and gaining, excluding the gain. Actually, this is what we call flipping. House flipping can actually, if it's done frequently enough, can actually turn into a self-employable tax business on Schedule C, where your houses are not seen as investments; they're actually seen as inventory. And you know, house flippers usually make a lot of money, but they also pay a lot in taxes. My recommendation usually is if you're going to do a house flipper, I would say go ahead and form an S corp, and then you can do your flipping all that you want. Use test, they say both, okay, and this is the ownership test that we're talking about, that they can satisfy the requirement. This is where if married, both spouses must satisfy the requirement of the use test. So generally speaking, if you do get married and you have the property and they come together, this is where sometimes they can run into some problems, but I don't know. We rarely run into this too often, and usually if we do, it's because it's like divorced people who end up getting married. And usually what they'll do is that they'll use one of the houses for 2 years and then sell it, or they'll turn it into a rental property. I mean, very common. You know, most of the time when they do get married, they do end up turning it into a rental property. So you have to have that in order for that to be taken if you want to get the full $500,000 exclusion. Now, if only one spouse meets the use and ownership test, you can still exclude up to $250,000. And in many cases, that's enough. Most houses don't necessarily gain that much over this time. Now, here in the Washington, D.C. metro area, they do. If you own the house for like 15 years, you're definitely going to go above $500,000 in gain. That's very common. So we'll pass all of the so the exceptions to the rule. Excuse me. If you have non-qualified use is when it's not taxpayer residence. It doesn't include any portion of the 5 years. Okay, so basically what happens is that if you have too much unqualified use, it can actually bust your exclusion. I wouldn't worry too much about this. This doesn't happen very often. It's probably not that important to focus on. The hardship one is something that you want to know, though, and I would know it cold, not because of the test, but I would actually know it cold because this is a very, very common question on the CPA exam. What happens is, and I've actually set up an example here. So we have a client, and so what happens is that we say, okay, you know, they're a single client. In order to use the house for the full exclusion, actually, let's see if I can blow that up a bit to make things easier for everyone. And you want to use the full exclusion. What happens is that you know, the full exclusion is $250,000. Very common where we see this a lot is actually military people. And of course, since I'm part of military, I get a lot of military clients. And so guess what happens? In the military, you get orders. Orders tell you have to go places. So that is actually a qualifying hardship where you can actually walk on and you can say, look, I had every intention of meeting this. I had orders in hand telling me that I have to go to Nebraska or whatever. So in order to qualify for the full exclusion of $250,000, you have to have done it for ownership and use test for 24 months. Say they only have 17 months of it. So you take 17 divided by 24, you get down to the 78.3%. So the total exclusion that this individual can have is $177,000. Now, some of you might say, well, wait a minute, that sounds pretty bad. So I mean, are these people going to obviously have gains as a result of this? And the answer is more likely than not, no, because I mean, think of it this way. If you own a house for, say, a year and a half, if it's going up in value by more than $177,000, I've never seen a scenario like that. So I would be very hesitant to accept the fact that that's the case. So but that's just my personal opinion on that. So that's kind of how the hardship exclusion works. But in order to qualify for the hardship exclusion, you have to as we unusual circumstance, very common is illness in the family, death in the family. One taxpayer dies, and the spouse continues to live. That's a hardship. Generally, the fair market value basis becoming fair market value is going to probably wipe out a lot of the gain anyways. But again, it would be considered a hardship under these rules. Okay, so that's kind of how they talk about it. Mortgage interest. Taxpayers allowed to deduct mortgage interest up to a limited amount. And it's deductible as an itemized deduction. What this means is that it goes on Schedule A. It is a below the line deduction, and it goes and like I said, it will go on Schedule A. Now, for debt that incurs before December 16th, 2017, the limit is $1 million. For debt incurred after December 15, 2017, the limit is $750,000. So, so what happens if you go above and beyond that? Let's see, I think I set this up. Yes, I did. Okay. So this is an example that I have where we have somebody who has a total mortgage balance of $1.3 million. The maximum amount allowed is going to be $750,000. Now, before I go on, let me focus on this $1.3 million. How do I determine what the 1.3 million is? And there's two ways you can do this. You can do what's called a beginning of year to end of year comparison, where basically what you do is that you take the balance at the beginning of the year, you take the balance at the end of the year, and you divide it by 2, and that's your average balance. Okay. The other way that you can do it is that if you know how much they paid in interest. So say for example, we know that he paid 1.3 million. Well, actually no, sorry. We'll say that he paid $35,000 in interest payments. And actually, I'm going to go ahead and dollar that real quick. So he paid $35,000. Say for example, I know that his interest rate is, and I'm just going to make this up. We'll say it's 3.5%. I can actually do this where I say equals this divided by this. That's his average mortgage balance. Now, some of you might say, why would you do one over the other? I'll tell you what, I've actually used both methods and figured out which was most advantageous to the client and usually run with it. But one reason why you will definitely want to use this method versus the averaging method. If the client gets a whole bunch of money all of a sudden and in March decides to do a huge pay down, then you definitely want to use the interest method in order to get a more accurate number. Or use the average number, take the better of the two. You're going to see a significant difference if they do a huge pay down during the year. So that's when you're going to want to really focus on that. Okay. Loan is secured by the home, blah, blah, blah. Yeah, it has to be. Okay, so the loan has to be secured by the home that is used to substantially improve, and it is considered acquisition debt for tax purposes, even if the lender calls the home a home equity loan. You'll see this a lot with some homes where if the person's buying, what will happen is that they'll say, hey, look, we'll let you buy the house, but we're a little concerned. So we want you to do 80% is going to be your primary mortgage. Then we're going to let you do a 20%, what we used to call these were called kicker loans back in the day, where they'll say, hey, look, we're going to let you buy the house, but we want you to do a kicker loan for the other 20%. That way, if you default on the kicker loan, that way if the value of the house goes down, they can still get their full value off of the primary mortgage, and the kicker loan is really their only loss. These kind of went out of style after the 2008 because the regulations changed, but I have seen quite a few people who still get kicker loans when they're buying houses, more than I would have expected. Points. Okay, so if you pay points, and what points is basically prepaid interest. You buy a house and you say, you go to the bank and you're like, okay, I need to borrow $500,000 to buy my first house. And the bank says, okay, we'll loan you the money, but we're going to loan it to you at, we'll say at 4%. And you go, gosh, I really don't like 4%. 4% seems really, really high. So what I'm going to do is I'm willing to prepay some interest up front in exchange that you take my interest rate from 4% down to 3.5%. And it's really kind of a mathematical deal. Points are a good deal if you're going to own the house for the entire term of the loan. They're a really bad deal if you're planning on selling the house within 5 to 7 years. Anywhere in between is kind of a hit or miss. You know, each point is 1% of the principal amount. Now, the tax deduction, it depends on how this gets taken care of. Points. So, for example, if you do points and you put no cash up front in the house, you will basically have to amortize those points over the term of the loan. If you pay cash up front and it's more than the points how much you paid for the points are fully deductible in the year of acquisition. Or you can amortize it. You can go either way. It doesn't matter. You can do either one or the other. This is something that I found. A lot of clients didn't know this, so we've actually found some hidden tax deductions. This is why when a client tells me they bought a house, first thing I do is I say I need your closing statement. We're going to try to find some additional deductions, and usually it can be very helpful for the client. All right, real property taxes. Yeah, most taxpayers are going to pay their property taxes through their escrow. What an escrow is that when you buy a house, you've got your principal, you've got your interest amount, and then they're going to have an additional amount that you're going to pay. Then what's going to happen is they're going to take the money, throw it into a bank account for you, and then as your insurance and your property taxes come due, they're going to go ahead and they're going to pay that money out to the respective people. Of course, they charge a fee in order to do this, but it generally works out so that you don't have to scramble to find money for taxes that are due that you can't pay. Okay, so the taxpayer gets a deduction when the property taxes are actually paid to the jurisdiction. That is for the most part true. There's something that they also have to be due to the jurisdiction. You can't just prepay taxes, and we learned that with the recent tax law change. Basically, what ended up happening is that everybody in Montgomery County and in Fairfax County tried to prepay their taxes so that they could get the immediate tax deduction, and the IRS said that they couldn't do it. It actually turned out to be a huge kerfuffle. I was actually skiing up in Pennsylvania when this whole thing went down, and I had to spend 1.5 days of my ski trip answering client emails telling them not to do this because the IRS wasn't going to let them get the tax deduction. It was actually some exciting times. My wife hated it, of course, because she thought when we went on vacation we'd actually have a vacation, but it drove her nuts. So the taxpayer gets to, okay, let's see, the property is sold in the, okay. So when the property is sold, this is actually a very important thing. This is code section 163C. I know this is code section 163. Oh, I'm sorry, 163D. Actually, let me make sure I know that. Okay, I'll tell you which one it is. It's not important to you. The reason why I know the code section generally, it's been a few years. I actually got into a big argument with somebody at KPMG about this because they tried to tell me that I couldn't take it. They wanted to take the deduction as it was paid instead of following this rule on this bullet point. And I quoted the law to this individual, and they told me, I'm sorry, we don't follow that law here, which really ticked me off. Now, I eventually got to a partner who looked at it and said, Kevin's right, you need to follow this, and ended up getting her into a little bit of trouble. But for a while there, I was not a very welcome person amongst certain people at KPMG because I was, quote unquote, causing waves. Sometimes, especially in our industry, sometimes you're going to show somebody something they didn't know and they're not going to believe you. This is where if you know the law, there's an old saying that they say in lawyers land. If the law is on your side, pound the law. If the facts are on your side, pound the facts. If neither are on your side, pound the table. And this person was pounding the table because they thought that they knew everything and they didn't. So it can be very interesting. And then, of course, like we said earlier, the $10,000 limitation on itemized deductions for everything. So the rental use of the home, we kind of talked about this already. I'm not going to worry about it. Taxpayers must live in the home for at least 15 days, rent it out for 14 days or fewer. Rental income can be excluded. Generally, it is. The IRS won't even ask for it. And if you get a 1099 on this income, you can report it and then you can exclude it because of that. And if you have any questions about that, I can talk about it. But that's an advanced question. I would not expect you to know that for any testing or anything like that. Okay. Residents with significant use. Okay, so the way that you're gonna report vacation home, you're gonna have rental revenues and gross income, and allocate expenses between personal and rental use. The way you're gonna do this in your software is that you're gonna tell it, I used it for this many days for rent, I used it for this many days as personal, and it's going to take your entire expenses that you input into the computer, and it's gonna say, this is personal, this is rental use, we're going to allow you to deduct this, and this other stuff goes somewhere else for a deduction if allowed at all. So for example, if I have interest that I pay on a rental property, this is going to bifurcate it between some of it that goes on to Schedule A and some of it that goes on Schedule E. So you need to figure, the thing will figure that out when you you tell it the right inputs. But very good example would be insurance. When I buy insurance, it's deductible for a rental property, but it is not deductible for a personal house. Therefore, when you bifurcate it off, it'll put the insurance on Schedule E, and then the other personal use just goes nowhere. Okay. Allocated, okay, non-deductible, like I just said. Allocated to rental or deductible only to the extent of gross income after deducting expenses. There are no losses for vacation home. This is generally true. Okay. Are there certain circumstances where I've seen that was the case? Yes, but I don't want to go into it because it's way too complicated and it's not going to happen very often. They are going to talk about the 3 categories or tiers of expenses. This I would probably expect to see on the test. I haven't finished building the test yet, so I will take a look at it. Expenses that are deductible without regard to rental activity, that's interest and rent expense. All other expenses are except for depreciation, and the depreciation for tier 3. Generally, expenses are allocated based on the number of days used. Exception for tier 1 expenses that can be allocated based on total days of the years. Let me tell you why they call this the tax court method. One of the few times that the IRS lost badly was this Bolton case. And basically what happened is that Bolton tried to use for his expenses that he used the total days in the total year instead of days that he totally rented it out. And the IRS tried to spank Bolton for it, and unfortunately they got spanked back hard. And so the IRS and in fact the IRS will tell you, we don't accept the Bolton rule. They will tell you that in all the publications, blah, 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 so on and so forth. However, all tax return systems will have, do you want to do this on the tax court method? We generally recommend that clients do. It usually ends up being a better deal for them. And so what will end up happening is that you want to be able to take that if you can. And so what we do is we generally recommend that. Every time that I've dealt with a vacation home, which I've only probably dealt with about 10 of them in my entire lifetime, because most clients, we talk them out of it. Okay, so if you have a rental property in D Creek and per governor, short-term rentals are not allowed. Oh, whoa. Andrew, very good question. I would say they are tax deductible, but it's also going to depend, is this now a vacation home or is this a rental property because it's not allowed to be used? That's a question that I think that is going to be interesting. Something I want to also throw out there, I know that we're getting close to the end of class, so I want to speed through this. But one of the things that I want to throw out there is, guys, I think a lot of stuff with this coronavirus and taxes, stand by for the IRS to do some very, very unusual things in the benefit of taxpayers. When you have a federally declared emergency like we have now that's affecting the entire country, the IRS generally steps aside and politicians usually are going to do things that are going to favor taxpayers significantly. We saw that earlier when they said, look, we're going to extend the tax season by 90 days. For me, it was pure pain. For all my clients, is a great thing. So anyways, that's kind of how all that works out. Excuse me, sorry. And for the 40 people that are now yawning, I'm sorry. I did not mean to spread a yawn like that. But I think that what's going to end up happening is you're going to see that a lot of people are going to be very, very flexible about how certain things are done, and I would stand by for that. Good question, though, Andrew. Appreciate it. This is an example. We don't have to worry about it. So non-residents. Rental use is at least 1 day. Personal use is no more than the greater of 14 days of 10% of rental. You can deduct all the expenses. However, if it's used for a day, okay. This partially, yes. You're supposed to bifurcate this out. So if I go and I use this house, say I go down to Florida and I'm going to use my house for. I'm going to go down there. I'm going to visit Florida and check out my property while it's empty. And I decide that I'm going to put a sleeping bag and I'm going to sleep on the floor while I'm out there because it's going to be more comfortable than if I did otherwise. For the most part, I mean, if I'm there for like 2 or 3 days, you're probably not going to see, the clients volunteer that information. It's going to come up to you. But if it does come to your attention that it does happen and the clients tell you that it does, yes, you would bifurcate it. I've actually never done that, only because I've never had a client tell me this. That doesn't mean that it wouldn't happen, but generally, and especially if it's only like one blooming day, I mean, I think there's kind of a de minimis out there, and look, that's kind of an aggressive position. Obviously, the correct answer is that you would bifurcate, but I mean, if they're there for like a day or two. I don't know. I probably would. Now, they're using this every year for 14 days every year because they want to use it as a vacation property for themselves for 2 years. Yeah, you're going to bifurcate. You're definitely going to do it because the IRS will target that very easily. So you want to make sure that gets done. Okay, losses on rental properties. We haven't talked about passive activities yet. We're going to talk about them a lot more when we get to the business section. Under Code Section 469, subsection C, all rental properties are considered passive unless otherwise proven. So, if you have a rental property, basically what's going to happen is that, and if it's a loss, it's going to be a trapped loss. Now, what does that mean? I told you about the 3 buckets. We have active, passive, and portfolio. So the active and passive, if you have income, the IRS is going to tax you immediately. If you have losses, the IRS is going to basically say, look, we're going to ask you to suspend the losses in the passive bucket until you have passive income or you dispose of the activity. And that's kind of important that you know. Now, there is a $25,000 rental real estate exception. You can deduct as an ordinary non-passive loss. However, you have to be materially participating in the activity. What is materially participating? It's facts and circumstances. I'm going to tell you the truth. About 90% of my clients qualify for materially participating. But again, if you make under $100,000, you're going to get the full $25,000 deduction. For every $1,000 for every $2,000 of additional income above $100,000, you're going to lose $1,000 of potential deduction on this. And here's the greatest news on this, folks. You won't have to calculate it. The computer is going to do it for you. The way I would probably show up on a test talking about this is that you would, I would say it's going to be an all or nothing type thing. I generally don't make people calculate things on a test. I don't make people calculate things on a test. In between the $100,000 and $150,000. Usually, what I'll do is I'll say, okay, guys, the guy makes $300,000. He's got $10,000 of losses. Can he take the loss? Your answer is going to be no. If the guy has $100,000 of income and he got $10,000 of loss, can he take the loss? The answer is going to be yes. The guy has, $125,000 of income, $10,000 of losses. Can he take it? And the answer is yes, but partially. That kind of thing is what's going to end up happening. Yeah, I'm not going to sit there and tell me exactly what his deduction is. That's not how I'm going to do that on this one. Okay. I tend to think that's a little sadistic in my opinion, but anyways. So business use of the home office deduction. Um, this is probably the last thing we're going to talk about. Yeah, I'll say this for later. I'm going to spend the next 2 or 3 minutes just asking, does anybody else have any other questions? Oh, wait a minute, hold on a second. So I had a question from somebody who said, what if you bought a home and let's say in a month or two you realized you couldn't afford it and you sold it and ended up making a gain on it? Would the rule apply where it's considered personal use, but because of the circumstances had to sell early? If the reason why you couldn't afford it is because you lost your job, definitely. Definitely. I would say that's a hardship. Generally, I mean, if you're going to turn it around and sell it, you're going to realize something very quickly. You're probably not going to make much of a gain off of that. And part of the reason why is because costs to buy and sell homes. I mean, usually real estate agents charge 3%. So if I have a home that's $500,000, I mean, we're talking $15,000 of costs, just the realtor's costs. We're not even including transfer tax, state stamp tax, county stamp tax, city stamp tax, all those taxes and fees and appraisals and all that other stuff they have to go through. You're probably looking at about on a $500,000 home. You're probably looking at about $20,000-$25,000. If anything, you're going to make a loss. Now, if your intention was to turn this into a rental property from day one, and it didn't work out, you would be able to write that loss off as ordinary income. But if you're going to use it as your personal home, you probably wouldn't be able to do that. All right. Outstanding question. All right. Okay. So, is there anything else that I have from anybody else before moving on? Okay. So we'll have class again 7:30 on Thursday. I'll try to have an answer for you on the quiz, and I'll try to get the schedule out to you later on today. If you have any other questions, feel free to reach out to me. Talk to you guys later.